Hello, everyone. Can everyone hear me? Can anyone hear me? Hello. All right. Awesome. So thank you guys for joining us again for day 2. I'm really excited to be here with you guys, and it's just an honor and a privilege to have you guys here with us. And we'll jump right into it. I'm sorry for taking your time. Yeah, we started quite late, 10 minutes on, but setting a few things in order so that you're able to get some quality work done today. Yeah, but you're here today. Yeah, it's going to be an interesting session. It's going to be intense, quite intense actually, but I've really tried my best to simplify everything in a way that it just gives a general idea on what these financial instruments are. Okay, so allow me to begin with a word of prayer, and then we'll jump right into it, and other guys will just join in the class as we continue. All right, let me pray. Father, in the name of Jesus, we thank you for this wonderful time. We thank you, Lord, for each and every member who is chosen to participate and take place, oh God, and I pray the Lord, even as we get to learn about unit trusts, as we get to learn about stocks, as we get to learn about bonds, Lord, we pray. And my Father, may we have an amazing time in the name of Jesus Christ. I give you thanks and all the glory, Jehovah God, for each and every person who's here with us. I pray, and the Lord, may you grant them the spirit of revelation, understanding, oh God, to understand how these financial systems work in the name of Jesus Christ. We thank you and we bless your holy name. For it's in Jesus' name we pray. Amen. Okay, so let's jump right into it. For those who are joining us for the first time today, we'll do a brief recap of what it is we did yesterday, as it's quite pivotal and important as we continue what it is we have planned for today. And if you were there yesterday, this is just a good refresher. And if you remember, there's an activity that we were to do. We were to do a risk profiling activity as we continue the session. So that's something that we have planned for us to do. Yeah, and then we'll jump right into what it is we have planned for today. So the way I've structured today, I've really tried to compress as many things as possible in a way that it gives you a general idea on how to start investing in this financial securities. So if it's stocks, if it's bonds, I've really tried to hone in on the most important bits. Pardon me. Yeah, so that at least you're able to know what to check on, where to start, and how to go about it. And the thing about today's session is it'll require a lot of due diligence from your end. By that I mean you'll have to put it into action and implement some of the things that you're going to learn today. Okay, as we don't have enough time to really go into details, but the nitty-gritties of these different financial instruments will cover it in our Fitnances Academy. So this is what we have today, and I'll just request you after the session, just get to do your due diligence and really exploit on your own with the foundational tools that we'll give tonight. Get to exploit on your own and get to see how that will fit into your own financial plans. All right, so let us start. We'll start off with our agenda today, once again, as we had mentioned, which is excuse me, understanding unit trusts, which we pretty much know as money markets, but it's just a component of unit trusts. We'll also look into understanding equity instruments, stocks, and we'll also look at understanding fixed income instruments, which is bonds. Okay, so it's gonna be quite intensive, and I hope not to lose you as we continue with the webinar, but I hope that it's going to be of value to you, as that is our main aim as Fitnances. Okay, so we're just going to do a brief recap of what it is we did yesterday, and we'll start first of all with the steps to financial planning. Okay, and just to bring that refresher to you, we looked at the four main components or the four main steps towards financial freedom. Okay, and we started off with financial security, which was being able to meet your immediate needs comfortably. Okay, and then we looked at the second one, which is financial vitality, which is being able to meet your needs and at least half of your wants comfortably, you know, and we were able to do a breakdown of our current expenditures on the same. And then the third thing was financial independence, which is being able to meet your lifestyle needs and wants comfortably, spending less and also spending less than you earn. And the last bit, the final step, which is the main goal that we are focused on, all of us, is financial freedom. And with financial freedom is being able to generate generational wealth for future generations. Okay, and we also looked at some few tips, just something to focus on, which is earning more, saving more, you know, and investing the difference, reducing your fees and taxes through tax avoidance, where we say that tax avoidance, it's pretty much identifying the loopholes in the system that you're able to exploit legally. Okay, and not tax evasion. Tax evasion is a legal one, which you avoid, you evade tax, and you invest the difference. And then getting better investment returns, where we said if you currently get a 9% return of your investment, you seek to find ways of how you can improve that to around 10 or even 11%. Okay, and then the last thing was changing your lifestyle in a way that it doesn't dent your financial capabilities. Yeah, and then you also looked at these main questions, which I hope you managed to just think through and look into them as you're planning for your 2022 financial goals. That what do you envision as your preferred financial future? What's your focus? What's your vision? What do you see? You know, how do you envision your cash flow? How do you envision your, let's say, your income level? How do you envision your investment portfolio in the next year? Okay, and then we looked at also at where you currently stand, which is now your knowledge, your habits, your value addition, you know, where we focused in on skills, and then on income level, expenses, savings, and investments, and then also looked at what is now your plan. So it was first of all assessing where you're currently at, and then looking at now where it is you're going and what's your plan for the same. And then we also focused on some more questions, which we actually realized this is one of the major areas that we actually need to answer, you know. The first one being, what is the hard work you feel like avoiding? Okay, when it comes to implementing the goals that you set for yourself, what is the hard work you feel like avoiding? What feels like too much work? Is it getting to read content that you don't understand each and every week? Is it getting to diligently budget and track your expenses each and every day? What is that hard work, right? And then what are your distractions and which ones will you have to manage and cut off with regards to achieving your financial goals? And in the event you fall off track, what will you do to get back on track, you know, and who will keep you accountable for that? Because this is something that happens. We are not perfect, you're all human beings. So once in a while we get to fall off, but what matters really is, will you get back on track and continue to where it is you are going? Okay, yeah, so, and then you also focused on this. And even as I was just preparing today, I just remembered to bring up this scripture once again, which is Hosea chapter 4, verse 6, that says, my people are destroyed for lack of knowledge, you know. And we just focused and said that the most important thing or place or step where you can start is investing in knowledge, you know. So if you're focused also on stocks, and let's even from today's content, stocks and bonds, how will you spend some more time researching and understanding how these different instruments work? Okay, so that's something that we also got to focus on yesterday, that in you increasing in your financial intelligence. Yeah, and we also looked at steps towards constructing your investment portfolio, and we said was, especially when you're investing in these different investment classes, you have to consider some foundational pillars before you get to invest into them. The first one is your financial plan, which we've talked about. And the second thing is now your investment portfolio. So with this, you look at your investment policy statement, which basically means what do you aim to achieve, all right? And then assessing your risk profile, And then after that, you check on your asset allocation strategies. And then the last thing is just keep on investing according to the plan that has been set. Okay. And excuse me. And then for the investment policy statement, it has different portions which we were able to go through yesterday. And if you didn't manage to be a part of us yesterday, it's okay, because we have a recording of the same. It's on our YouTube channel, and I'll definitely share the link to it once the session is done. So you look at your introduction, what your investment policy statement is about, under the purpose section, the duties and the responsibilities of the involved parties, which is you, the custodian, and the manager. And then we look into the procedures. How will you work around the investment policy statement? How will you keep on improving it? Okay. And then also your objectives. What do you want to achieve? Do you want to invest for the long term, the short term? Do you want to invest for, let's say, buying a home or starting off a business, something of that sort? Okay. And then the next thing is, the last thing was now your constraints, the different factors that are unique to you that will influence your individual investment decisions. All right. And then you also looked at your risk profile. Yeah, so where you stand from the ultra conservative all the way to the aggressive investor. And we looked at different parameters, and we'll get to try this out in the next few minutes. And I'll just show you how we'll go about it. Okay. So it's something that we also looked at. Where do you stand as your risk profile? For this is one of the most important things when it comes to embracing different investment opportunities, right? So the next thing was your willingness to take risk, where we said, do you have the, what's the word? The capability, or are you comfortable in accepting certain risk levels, you know, especially in your mind? What will be your reaction when you take on some certain aspects of risk, right? So that's something you also looked into. And then the other thing we looked at was now your capacity. Do you have enough money? Do you have, let's say, like an emergency fund when you're considering different investment opportunities, right? And then we also looked at now our activity, which we were to do yesterday, but we didn't manage, which is now assessing one's risk tolerance. And this activity will take roughly 7 to 10 minutes. And so what it is I'm going to do is I'm going to send this link onto the chat box, okay? So just give me a few seconds to do that. And as I do so, I'd love to ask for a volunteer. All right, love to ask for volunteer who will join me in doing this risk assessment. Right, so if anyone is willing to do so, it's okay. You can just like raise up your hand, just let me know. Let me switch. Julia. All right, thank you. Awesome. So let me just do this. Let me switch my screen. Can you see the risk profile? Hey guys. Can you see my screen, or have you been able to open the link? All right, okay, so what it is you're going to do is I'm going to walk through this with Julia, and what I'll require for you guys to do is open the link on your phone or your laptop, whatever device it is that you're using, and we'll go through each question, all of us together. So let's say, for example, if we tackle, for me, part of investing is experiencing the ups and downs. I'll get to explain, and then Julia will make a selection, and then for you on your end, make your selection, all right? And then we'll go to the next one. I feel stressed when making important financial decisions. Make a brief explanation. As Julia responds to us, also respond onto your risk profile, which you've opened on your phone or on your laptop. I hope that's clear. Please let me know if that's clear so that we start, as we don't have much time. Okay, thanks, Imelda. All right, so Julia, if you can unmute yourself, we can just start this out.
Hello.
Hi.
Okay.
Yeah, so let's start. For me, part of investing is experiencing the ups and downs. Like it basically means you're comfortable with when the markets are high, when the markets are low.
Disagree.
Disagree. Okay. So as you do this, guys, also remember now to do it on your own respective device. Okay, so the next one is you feel stressed when making important financial decisions.
Strongly agree.
Strongly agree. Now inasumbua.
God only
Okay.
knows.
Right. The next one is it's important for you to take financial risks.
Neither agree or disagree.
Okay. Right. And remember, guys, the main aim here is to be as truthful with yourself as possible. So I told you, but you're getting strongly disagree selections pretty much most of the times. It's still okay. All that matters is that you really get to be honest with yourself so that you know where it is you lie. All right, so the next one is, I believe that I generally take bigger investment risks with my money than other people.
Disagree.
Disagree, okay. I always overreact to unexpected bad financial news.
Strongly agree.
Strongly agree. All right, I will still consider making risky investments even if I had made significant losses in the past.
Disagree.
Disagree. Okay. The next one is I worry about things going wrong with my financial decisions.
Strongly agree.
Strongly agree. Okay. To avoid the possibility of losing money on my investments, I would rather not make a financial decision.
Agree.
You agree? Okay.
Yeah.
I hope your other guys are still doing so on your devices. You're on the second page. The next one is to get higher long-term returns. I'm happy to risk a short-term fall in value in the value of my investment.
Agree.
Agree. All right. Let's go to the next one. Others will say that I like taking risks with my money.
Disagree.
Okay, disagree. I think by now Chans are gonna like the gist, like in a country clear pole pole. So right, so the next one is I feel fairly relaxed about uncertainty regarding risky investments.
Disagree.
You disagree. Okay. When you consider the risks of investing, you feel quite anxious.
Agree.
Agree. Okay. The next one is I expect my investments to sometimes go down in value as well as up.
Agree.
Agree. Okay. I will be happy to tolerate fluctuations in the value of my investments to get a better return in the future.
Hey.
Can you stand the ups and downs in the short term just to get a better return in the long term?
Yeah. Agree.
You agree? Okay. The next one is when I make an investment decision, I usually feel concerned.
Agree.
Agree. Okay. Seeing my investments go up and down in value is part of investing money.
Agree.
Agree. Okay. The next one is I will get a thrill from making risky investments with my money. So let's say, for example, if it's like cryptocurrencies.
Disagree.
Disagree. All right. I would accept fluctuations in the value of my investments for the potential to gain a return above inflation.
Agree.
Agree. Okay, awesome. So we are done. Are you the rest? Are you guys done before we submit? Mm-hmm. All right, I hope so. So Julia, your risk tolerance was measured as low to medium, which puts you in the cautious category. People in this category are cautious with their investments. They are more comfortable with investments with reasonable returns rather than risk investments with potentially high returns, but also potentially high losses. Okay, so when you get this information, what does it mean? You know, but before we get to that, have you guys been able to try what has come out of your risk profile assessment? Let me know in the chat.
Hi, Teddy.
Hi.
I came in late, unfortunately. So did you send a link or should I just search for it?
Yeah, I did. Let me resend it. There
okay, thank you.
Karibu. Anyone else, for those who are here with us? Has anyone tried? Has anyone tried? Caleb, what's yours? How about you, Nelly, Cleon? Thank you, Melda. Nice. Awesome. Candy, Manuel, Yvonne. Caleb, Margaret, moderate, but I haven't quite. It's still okay. It's just to assess your risk level. So we have cautious, moderate. Anyone else? Any last person? Candy, moderate. Awesome. Okay. All right. That makes sense. Thank you, guys. So the reason as to why that is important is because when it comes to building your investment portfolio, moderately aggressive. Awesome, Manuel. Thank you. All right. So when it comes to building your portfolio, that is what will pretty much determine the investment decision that you're going to make. Right? So you'll find that if you can remember from yesterday's example, if you were there, but if not, it's still okay. I'll still make illustrations. So let's say, for example, for someone who is on the cautious towards the lower side, you'll have a higher concentration around unit trusts and bonds. Why? Because they are low risk, low return investments. Okay, and you'll have a smaller percentage on high risk and high return investments, such as, let's say, cryptocurrencies, real estate, and stocks. Right? So for the other person, for someone who is pretty much moderate towards the moderate aggressive side, you will have a slightly lower concentration around unit trusts and bonds. Okay, but then you'll start building a strong portfolio around high risk, high reward investments. Okay, so be it something like crypto or derivatives, be it something like real estate or even private equity or hedge funds or even stocks, you'll start to focus a little bit more on the high risk, high return investments. Okay, and if you're someone who's on the overly aggressive side, you'll have a very small concentration around unit trusts and bonds. Okay, are very small, pretty much at most, let's say like 15 or 20%, or even less, let's say 10, depending on your risk appetite. And you'll have a significant portion, around 70% plus, on the high risk, high yield investments. Okay, and if you're asking yourself, how do I move from, let's say, the ultra conservative to the moderate? How do I move from the moderate to the overly aggressive? It's simple things, because because you have to look at your emotions, because here is it's where emotions take place. All right, let me do it again, Imelda. So I was saying, let's say if you find yourself on the lower spectrum, which is the ultra conservative or the conservative investor, you'll have a huge concentration. Let's say, for example, 80% on unit trusts and bonds. Why? Because these investment classes are low risk, low return investments, because you're really focused on capital preservation. All right. If you're on the moderate side, but for you who's on the ultra conservative, you'll have a very small focus, towards high risk investments such as, let's say, cryptocurrencies or private equity, real estate, or stocks. Okay, simply because you don't have, let's say, either the willingness or the capacity, or both, to handle the fluctuations that come with these different asset classes. Okay, and if you're someone who's towards the middle, that is the cautious and the moderate, you'll find yourself gravitating towards an almost equal balance of the low risk investments and the high risk investments. Okay, so if you're, let's say, the moderate investor, you'll find that you'll, let's say, for example, have like either 70% of the low risk, low return investments and a 30% mix of the high risk, high return investments. Okay, so it's pretty much the specific balancing will be according to your own personal needs. Okay, but for you who's at the middle, you have an almost equal, either 60-40, 55-45, either 70-30 or 65-35. It depends with your own personal situation, but that's pretty much the range. Okay, and then for someone who's towards the moderately aggressive, towards the aggressive side, you'll have a smaller concentration on the low risk, low return investments, and then you'll have a higher concentration on the high risk, high return investments, simply because you have the willingness to take that risk upon yourself, and you have the willingness to, or even the capacity to embrace these different risks. Okay, so that's important, because now when you're looking into constructing, let's say, a stock portfolio, you will have to gauge it by your overall portfolio. All right, you'll have to gauge it. Let's say, do you have a proper mix of low risk investments, that in the event you lose some money investing in stocks, you still have a good stash of cash that is still in the low risk investments, such as bonds and unit trusts. Right, so that's one of the main areas that you have to really focus on and understand your risk profile when it comes to investing. Okay, so I hope that has been clear. And also, as you get to do this investment, this is an activity you usually do with your fund manager, the asset manager. They really walk you through step by step and really get to understand all your goals. But remember, as I said yesterday, the main aim is to understand the whole process. How is this process done from point A to point B? All right. And so now, after you have understood your risk profile and where it is you start, where it is you currently stand, you get to look into the different investment managements. So you'll find for someone who is pretty much towards the aggressive side, most of the times they'll have a good foundation and understanding of how the markets work and how investing works. So they have the capacity to actively manage their portfolio. All right, but for someone who's a bit cautious, or you're starting out, the best route is always to take the passive portfolio management, where you can create a portfolio based on a replica of an existing portfolio, or you get to have an asset manager do that for you, and we'll get to look into that as we cover unit trusts. Okay, so the goal pretty much is usually to move from passive portfolio management to active portfolio management. And it requires some skills, some financial analysis skills, some investing skills, some trading skills, in order for you to be able to actively manage your portfolio and actively rebalance your portfolio when the need comes. But if you don't want to involve yourself in that much work, it's preferred that you get an asset manager or a stockbroker or any other financial intermediary to get to do that work for you at a very small fee. Okay, because they are the ones who are now pretty much focused on doing that for individual investors and even corporate investors as well. All right, so the next thing is In conclusion, now, as we said, you first of all develop your financial plan, understanding where you're at and where you want to be. Number two, you build your investment portfolio, understand the investment objectives, the different asset classes, and your risk profile. And when now this is done, you now move into the specific asset classes, all right? And we'll start off with understanding unit trusts. And I know that you guys have been probably heard about it here and there, you know, and I just want to show you guys something. Have you seen any of these marketing materials out there? And what do you think it means when you see all these details? 8.82%, 10.5%, balance fund, bond plus fund, equity fund, money market fund, effective annual yield. And so what do you think it usually means when they market this out there for you as an individual investor? Yes, the percentage return on the investment, which is usually one of the most important things. Yeah, yes, it's a percentages, yeah, as the interest rates gained. Okay, and you'll find that I remember there's someone who was constantly asking me, what does this PA mean? You know, I wanted that you stand to earn up to 11% PA, you know, or someone say, or you get to see the net annual effective yield over here to be 8.82%. So what does that mean? Right? And so this is just to welcome into the world of unit trust, and it's really considered to be a low risk, low return investments and a very good starting point for anyone who's starting out as a beginner investor. Okay, so you're going to look into it briefly for a few minutes, look at the most important parts about it, how to go about it, and I'll leave the rest to you to just do your own due diligence. But what's the focus is a very good foundation on where to start and how to move to the next steps, right? So let's jump right into it. But first, there is something that you now need to understand when it comes to unit trusts, all right? Because pretty much just in its most basic form, a unit trust is a pool of investments, different investments. It's like a basket that you have different oranges, mangoes, bananas, pears, apples, you know, that you just get to get a portion of each and every one of them. Okay, so in understanding unit trusts under which money markets lie, we need to understand these four areas. We first of all need to understand the primary and secondary markets, financial markets. You need to understand the capital versus money markets. We need to understand the asset classes, and we need to understand pooled investments, okay? Because now, let's say, for example, if it's a money market fund, this advertisement that you're constantly seeing, they all fall under, it's built on the premise of these four areas, okay? So the first part is primary and secondary financial markets, and these are the foundational pillars to investing. And the primary market is where securities are created, where companies sell new stocks and bonds to the public for the first time, such as with an initial public offering, IPO. All right. So think about it this way. Let's use the example of a car. Right. When DTDOB sells a Mercedes-Benz into the market, that area, you know, DTDOB itself is considered to be the primary market because they are selling a new unit into the public. Okay, I hope that's clear. So let's say if it's the latest S-Class, all right? If it's the latest S-Class, DTDOB will be the primary market that no one has seen this car before, no one has sold this car before, and they'll be the first guys to bring this vehicle into the market. It's the same thing as now the financial market. So if a company has a debt offering that it's bringing to the market, it will sell it through the primary market. If a company is floating stocks for the first time, it's going to sell it through the primary markets, right? And then we have the secondary markets, which is basically where securities are traded after the company has sold its offering on the primary market. All right, so let's go back to our S-class example. So Adobe has already sold this S-class into the market. So I get to buy it. I use it for a while, I enjoy it. But then I want to do something else. Let's say I want to try out a different model, or I want to get some cash, or just want to liquidate this asset. So what it is will I do? I will go to the secondary market. Let's say, for example, if it's an online car buying website, you know, or just a car dealer, or just someone who sells secondhand cars. That is where I will go to sell this asset that I have, and that will be considered as the secondary market, right? So what happens in the financial markets is each and every instrument, you know, each and every financial asset is first of all introduced into the market through the primary route. All right, and then as it's there trading in the markets, it's now considered to have shifted into the secondary market set. When you're now trading, you're not trading something that is new, but you're trading something that has already been bought by someone else. Okay, and this is very important, especially when it comes to stocks and bonds, you know, because you have to understand how stocks operate in the primary markets. You know, let's say, how can you invest in stocks in the primary market if it's an IPO? How can you invest in the secondary markets if it's just the not casual day-to-day trading? Okay, so the next thing is the capital markets versus the money markets. All right, so the main difference for you to remember between the capital markets and the money markets is the time period. All right, so for the capital market, it's geared toward long-term investing, where companies issue stocks and bonds to raise money to grow their businesses. So this means that in the capital market, you expect that these financial assets will be there for a very long time. You know, they won't mature in like 3 months or 4 months. So let's say, for example, if it's a government bond, it's considered to be under the capital markets because its maturity period is longer than 1 year. All right. And for the money market is a short-term lending system where borrowers tap it for the cash they need to operate from day to day for a term as short as overnight and no longer than 1 year. So this is a distinguishing factor. All right. So for example, a treasury bond, all right, will fall under the capital markets as it has a maturity for more than 1 year. But something like a treasury bill or a money market fund will fall under the money market simply because its maturity is less than 1 year, right? And there are different mechanisms as to how different financial assets are invested when it comes to these different disparities. Okay, so that's a very important definition for you to understand as we dive into stocks and bonds tonight. The next thing is the financial assets that currently exist, you know, so this is pretty much the investment universe. And this is very important because everything that is considered as an investment, it is found within these asset classes. Everything that you think about is found within these asset classes, all right? And when it comes to unit trusts, as you remember, as you've said that they are pooled investments, you'll find that it's a pool of a fraction, let's say a quarter of equity instruments, a quarter of debt instruments, let's say a quarter of derivatives, a quarter of alternative investments, you know, and pretty much even just a quarter of another pooled investment fund, all right? So the main thing over here is to understand this in universe as now different financial products are built out of this. Okay, so the first one is equity instruments, which we're going to cover in depth tonight. So this is just a small description: stocks and shares with low to mid liquidity and high risk, as we've covered under the risk profile. And then the next one is also the long-term investment options, simply because of liquidity. And liquidity basically means the capability of converting an asset into cash. So high liquidity means it's easy for you to convert this asset into cash, and low liquidity simply means that it's a bit hard for you and it's going to take much more time for you to convert this asset into cash. And then the next instrument is debt instruments, you know, where this is now where bonds lie. And so you have corporate and government debt. They are highly liquid, which means they can be converted easily into cash, but it also depends on the maturity time period and also low risk. They're pretty much low risk as you are sure that you'll get your principal. All right, but it also depends. It has some factors into it, but we'll look into that when we cover debt instruments tonight. And then they have short-term and long-term investment options. Okay, and the next one is alternative investments. So alternative investments are pretty much non-traditional investments. As you can see, as I've noted here on the bottom right corner, that equity and debt instruments are considered to be traditional investments. They've pretty much been there for a very long time. Okay, but as the market has been growing and progressing, there have been new and different asset classes introduced into the financial markets that people can trade in and invest in, all right? And so the first one is real estate. And so with real estate, it's basically what it is we currently know and admire as Kenyans, land, investing in real estate trusts, which we cover more in our Fitnances Academy. The next one is private equity, which is basically the investing in private companies which are not listed, publicly listed in the financial markets. All right. And then we have commodities, which have actually been there for a very long time. So with commodities, basically where you invest or trade in different commodities such as gold, silver, precious metals, oil. If you've been able to hear things about it. Get to invest in food commodities such as maize, beans, potatoes. So let's say, for example, if I was to invest in commodities in Kenya, I would say that I'm expecting that the price of a 50 kg sack of maize, it's going to be around 1,000 shillings in the next 3 months, so you build an investment product out of that, okay? And then you also have cryptocurrencies, which are a derivation from the blockchain technology. And then you also have hedge funds, and hedge funds pretty much invest in all these different asset classes, but this is more prevalent towards mature markets like the United States. So they have low liquidity, high risk, very high risk, as they are quite volatile, also dependent on the liquidity aspect, and then their long-term investment options, right? So something I want you guys to notice is for these three, all right, just take up a note on this. There are these three main asset classes, all right, equity, alternative, and debt, okay? So let me explain financial derivatives. They are quite complex, so you don't have to stress about them, but these are complex financial assets whose value is derived out of existing assets, such as stocks, bonds, or commodities, and they have different terms to it, but I won't go into that. For example, you have futures. So let's say we have a stock derivative. Okay, so a stock derivative will be sold as a package, will be traded as a package of different stocks, which have been weighted in a different way, in different manners, mechanisms, and ways. And it's based on how the pricing of those individual stocks will be. So let's say, for example, we will get to derive, on commodity, yes, maize, soybeans, which other thing? Pretty much anything that's considered a commodity, art pieces, luxury cars, anything that is just considered as a commodity, But the thing about commodities, guys, is especially in the current market, it's the derivatives of commodities that are pretty much traded more than the commodity itself, okay? So what do I mean? You remember this example that I was showing you about stocks. Let's say, for example, gold. You'll find that the value of gold, I can't remember the actual value. Let's say the current value of physical gold in the world right now is around, let's say $500 million, okay? But you'll find that for the gold futures or for the gold derivative, you'll find that it's a $3 trillion market, okay? So you're asking yourself, are we trading on something that we don't have as an actual product, and pretty much most of the time, yes, and that is how financial derivatives work. Okay, but that is something that we'll get to focus on way later. It's not as important right now. Okay, so because you need to understand all these asset classes at first, and then you now understand how derivatives work, but it is a part of the investments universe. And then to the last thing, which is now pooled investments. Okay, so what pooled investments basically means is it's like a basket. All right, so it's a basket of different assets. So let's say have different proportions of equities, debt, alternative investments, be it real estate or cryptocurrencies, and I just get to have this as a fund, that I can offer to an investor for them to buy into it. Okay, so this is how pooled investments work. This is where money market funds lie, and this is what is usually known as unit trusts. Okay, so they have variable liquidity, which is dependent on the investments in that pool. Okay, and also different risk profiles, also dependent on the assets that are in that pool, right? So I hope that is very clear to you guys, as it's forming a foundation of what it is we are going to cover next. All right, so pooled funds in a portfolio from many individual investors that are aggregated for the purposes of investment. Okay, so pretty much what it basically means is, and when you look at these different aspects, so you have three main categories under pooled investments, or commonly known as unit trusts, right? So the first one is the mutual fund, the second one is an index fund, and the third is an exchange traded fund. Why is this important to you? Especially when you're starting out as an investor, you don't know what is what. You don't know which is the right mix, okay, of assets in an investment portfolio. So the best route is always to take up a mutual fund or an index fund or an exchange traded fund, which we commonly refer to as an ETF in the investment world, that grants you exposure to these different financial assets without you getting to do the financial analysis and the professional nitty-gritties that are needed in assessing these financial products. Okay, so let's jump right into it. So the first one is mutual funds. And so mutual funds is where now we see the money market funds, the 10% per annum, 15% per annum, 20% per annum, and all those marketing gimmicks, okay? So for the mutual fund, it's a type of a financial vehicle that is made up of a pool of money collected from many investors to invest in securities like stocks, bonds, money market instruments, and other assets. Mutual funds are operated by professional money management. So for example, in here we are 17 guys, okay? So the 17 of us get to raise, let's say, like 1,000 shillings each. So we'll have like 17,000, all right? And we have a money manager who's like the middleman, who stands at the middle, okay? And their work is to outsource different investments, different asset classes. Let's say if it's a Safaricom share, let's say if it's a government treasury bond, let's say if it's like a real estate portfolio, without getting to have us invest in the actual property itself, all right? So what is the fund manager is going to do, which is this guy over here, this person is going to take this amount, all right? And according to the investment criteria set, this guy is going now to invest it into these different asset classes, depending on the different portfolio weights that they have chosen, okay? For example, if it's a money market fund, I know that this is a low risk, low investment. So the assets that the money manager is going to choose will be the low risk and low return assets, right? So let's say, for example, like the government treasury bill, that lasts for a year. The other one being corporate debt of highly stable companies, all right? And even something like bank deposits. Are we together? So that's how a simple money market fund works. So you get a pool of these funds, they invest it into this, And the other thing is these different asset classes have different returns. Remember that, okay? So you'll find that the T-bill has like, let's say, for example, roughly 7%, all right? And then we'll find that, which is the other asset that we've talked about. Let's say like the commercial debt has a return of like 6%, okay? And then we'll find that if it's the bank deposit gives 8%, all right? So what is that the money manager will do is, as they have invested into these different assets at different times, at the end of each day, they are going to generate a return, all right? And at the end of each day, they're going to generate a return, which they are going to compound, if I may use that word, towards a final figure that they will use as the annual investment rate. But I'll explain that later as we talk about interest rates, okay? So that you understand what it is that they mean when they say effective annual yields, all right? But I hope that is clear with regards to mutual funds. Different investors, the 17 of us, invest 1,000 shillings each into this money market fund, let's say by Fitnances money managers. And us as Fitnances money managers, we outsource good investments, low risk, low return. We get returns from that. And then after we've gotten returns, we get to bring those returns back to you as the investor and distribute it according to your percentage in this pool, okay? So I hope that's very clear when it comes to mutual funds and money markets, right? So the next thing is index funds. So index funds, basically what they mean is an index is a construction of different securities, you know, with different weightings. That's considered an index. So when you talk about an index, it basically means that you have a pool. Let's say, for example, if it's a stock index fund, you'll have different stocks with different weightings, and they've constructed something called an index out of it, okay? So let's say, for example, if us as Fitnances Africa, we create an index of the securities at the Nairobi Stock Exchange. Let's say we have a Safaricom, let's say we have an Equity, let's say we have a Centum, let's say we have a Williamson T, let's say we have a Longhorn, and let's say we have Cooperative Bank, okay? So we'll create an index, you know, of this fund, and it's going to monitor its performance, okay? And so what the index fund will do, especially for you as an investor, someone will now come and just build a complete replica of this same index, okay? So let's say now, remember the 17 of us, let's say you're an investment syndicate, right? Very, very amazing people. So each and every one of us now comes, let's say, with 1 million shillings each. So with 1 million shillings each, we'll have 17 million shillings. So if we invest into this index fund, it's going to be a replica of this index that Fitnances Africa has created, all right? So that's how an index fund works. So anytime this index goes up, our fund itself will increase in value and we'll be able to make some capital gains out of that, all right? If the stocks in the index go down, what it is that's going to happen is that the value of our index fund will go down and we might make some losses out of that, okay? But this one we won't, we cover it more in our Fitnances Academy, especially with regards to index funds. And most of the times you'll find that there are index funds pretty much for stocks and bonds and some commodities, all right? And yeah, any other asset that is relevant to this, but don't stress much about this. It's not as important right now. Index the word. So index itself basically means what would be the right word to describe an index? It's like a tracker. Let me use a tracker, you know, like tracking, like car tracking. It's like a tracker. So an index, it's like a tracker built of different securities, okay? So if I form an index, or let's say like a tracker of Safaricom, Equity, you know, and Williamson T, you know, I'm constructing a tracker that monitors how this operates. All right. I think let me just show you an actual example so that it's easy for you. Just give me a moment. Okay, where's this thing? Okay, what is going on? Yes, you track how those companies perform. All right, so let's say we look at the Nairobi Allshare Index. All right, so does it have the details? Okay. Right. So, for example, one index is the Nairobi Allshare Index, and this is an index or a tracker of every stock that is listed on the Nairobi Securities Exchange. Okay. I won't go into all these details about the price, the highs and lows, because I just want you guys to understand basically what an index is. All right. So so that's pretty much it with regards to an index and the different indices around the world. Let me just show you an example. An example of one popular index is one in the US that's called the S&P 500, which tracks 500 top companies that trade on the New York Stock Exchange. And you can build an investment product out of this, but that is for a later date, okay? And then the last thing is now exchange traded funds. And so what an exchange traded fund does is it's a basket of securities that trades on the exchange just like a stock does. All right. So remember the difference between an index fund and an ETF, let me just say that, is this one is not really listed. Ni kama una copy. No. So if I as Steady, I've created an index fund of 5 stocks, what you just do as the investor is you just get to copy what it is that I've done and use my index as the benchmark, okay? But for the ETF, if I have this pool of 5 stocks, I will list them as one basket, let's say like Teddy's Peak, all right? And what it is you will do when you go to the NSE portal, as you see Safaricom being traded, Equity being traded, Cooperative Bank being traded, you'll get to buy my own pick, my TED ETF, all right, as an investment option. So you'll find that this is a basket of different stocks and it's very popular in the United States. So instead of buying an Amazon share that trades at $1,000, you'll find an ETF that has a mixture of Amazon, Facebook, Nvidia, or any other public company in the US, and you just get to buy that, all right? But this is not our focus today. Our focus today is on mutual funds, all right? So I hope that is clear to you guys. And yeah, so let's move on to the next thing. Yo, man, and time is flying. What? Okay, so the next thing is now how mutual funds work, which I've pretty much explained, okay? The fund manager constructs a basket of financial assets that are based on the investment objectives and criteria of targeted investors. So let's say if Britam asset managers want to create a financial fund for low risk investors, they'll create a money market fund for that and have the right mix of low risk investments. It's okay when I show will. Yeah. But these are the major parts. What it is I'll be doing, guys, I'll tell you what's the most important parts and what it is are just simple explanations to make things clear, all right? So you say that, so the fund manager, let's say someone like Britam will will create a money market fund for low risk investors, right? And then Britam themselves will get to buy different portions of these different investment or asset classes to build a portfolio, all right? And after they've built that portfolio, they now come and sell it to you as a money market fund offering. And what it is you'll pay, you'll just invest into the fund, and at the end of the year, you just pay an annual management fee. All right. And then the last step is the fund manager then manages the portfolio and aggregates returns to the different investors who invested into the investment pool. I really hope that is clear. If you'll forget everything about index and ETFs, it's okay, but just remember this process with regards to mutual funds and money market funds. And also the other thing, guys, I've forgotten to mention is you can have different mutual funds. An example, number one, is a money market fund, which we now are seeing getting quite common in the market, all right, which is for low risk, low return investors. You can also have an equity fund, which I'll cover when you focus on equities, which is focused on a pool of equity investments or share investments. And you can also have a bond fund, which will also get to see examples on common newspapers such as the Business Daily and the Nation. All right. So which is the next thing? Okay. So for example, if an investor wants to invest in a professionally managed pool of bond instruments, okay, the investment manager will create a pool of bonds. So we have bond A, bond B, bond C, bond D, with different characteristics that will suit this investor. Let's say, for example, Yvonne, all right? And then all you have to do as an investor, as Yvonne, is to just purchase a portion of the pooled bonds, and you will receive an aggregate return from the fund as a agreement set, right? So the most important thing is to understand that you can invest any amount and have different exposures to something that you will not have been able to do as an individual investor, all right? So here's the categories that I was telling you guys about. So you have the money market funds, you know, maturities less than 1 year. Common assets include commercial papers. Commercial paper is simply a short-term corporate debt, all right? So a short-term corporate debt, yani deni ya kampuni for a very short time. So let's say, for example, I want to pay, a company wants to buy some inventory. They will give out this short-term debt, you know, called a commercial paper, all right? And then you have short-term government securities and bank deposits. And this is the most common, where you see guys like Saiton, Sanlam, Britam, you know, Genghis, or any other different asset manager that exists in the market, all right? And then you have balance fund. So balance fund, just to bring it into context, remember the guys whose risk profiles were cautious and moderate. This is where you would lie best, okay? This is where you would lie best because it's balanced. You might have an almost 50% bond, 50% stock fund, right? And especially when you're starting out, this is the most preferred way, so that as you continue understanding about the market, you're able to now do this on your own and not have an investment manager do that for you. Okay, and so for someone who's on the ultra conservative, definitely the money market fund and also the bond fund, but you'll also need to balance it well so that you're able to get liquidity out of these different bonds. And for someone who's on the moderately aggressive side, towards the aggressive side, an equity fund will be suitable for you, which is just a pool of different stocks, you know, which is structured, and then you get high risk, high return, suitable for investors who want to professionally managed stock portfolios, okay? So bottom line, if you forget everything else that we've talked about, if you're a starting investor, this is the best place to start, okay? If you're starting out, it's your first time investing, this is the best place to start because the fund manager does the due diligence for you, because that's also a lot of work for someone who has not really learned how to go about it, all right? So if you're starting out as an investor, this is the most important bit, all right? That mutual fund that will be relevant for your portfolio. Okay, are we clear up until this point? Please let me know in the chats. If you're lost, please let me know. If you're lagging behind, please let me know so that I know how to adjust and how to better prepare for the next sections, right? Yes, sort of. It's okay. So far, so good. Okay. All right, guys. Thank you so much. Let's move on to the next thing. All right. So interest rates. So remember what it is you've said, that the fund manager now has different investments. Let's say I have a bond, let's say I have a stock, and let's say I have a debt, a company debt. Okay, so this bond, this government bill will, let's say, for example, pay you an interest of like 7% in March, okay? And then this stock will probably appreciate in value by July, all right? And then we have this third instrument, which is now the company debt, that is going to mature in, let's say, in 3 months, which is probably around June. And then it has a rate of, excuse me, a rate of around, let's say, 6%, okay? So we have a 6% over here, a capital appreciation of this stock of around 3% or 5%, and this treasury bill that has an interest rate of 7%, okay? So what the money manager will do is they will balance out that portfolio, okay? They will balance out that portfolio, will bring in different rates, will bring in, you know, different weightings and structures and timings for the returns, all right? And then what it is that they will do is now they will get to aggregate that into one different rate. So the thing is, killer asset comes the different time period that they're going to pay out, let's say, an interest, okay? So it's the fund manager's work to get to balance all that and bring it into one common valuation, okay? So as time progresses, the fund itself will be calculating interest on a daily basis. So for example, how did the stock perform? Did this company pay their debt? Did this company pay their debt? Because now in that pool, near a lot of assets that are there, okay? So now when you see a company market their interest rates, what it basically means is for the different pool, for the different assets in their pool, when they have been able to merge, combine, and aggregate those different rates, they are able now to say that this year we made a fund, we managed to have an annual yield of 10.5% or 8.82%. Okay, and this is one of the most important things that you look for when you're looking for money market fund, but we'll cover that later on. All right, so when you see a company saying that our effective annual rate as at 28th December 2021 was 10.5, it basically means that they have aggregated those different rates. This rate in Alipa June, this rate is being paid in July, this rate was in August, and they've brought it together to give you a comprehensive number to help you understand how the fund is performing. All right, so when you see 10.5% per annum, it basically means that at the end of the year, if you started with 1,000 bob, all right, and you never invested any other cash, all right, at the end of the year, you expect to receive 1050, actually 1150 from you, yeah, all right, so somewhere around that, okay, it's going to be 105, so 105, so it's going to be 105, 1,105 shillings, okay, and this is pretty much most of the times after tax. Okay, so that is how you're able to gauge when it comes to money market funds. So when you see this, it's compounded daily, yes, but utapata, if the difference is the 105, okay, so let's say you might find, if you just do a very rough estimate, you'll find if you divide the 105 by 365 times in a year. All right, so let me just do that. 105 divided by 365, you'll find that each and every day you are earning an interest of 0.3 shillings on the 1,000 bob that you had invested. Okay, so that's pretty much how interest rates work. But this, you don't have to focus much on this. This is a fund manager's work. It's why you're paying them an annual fee to do all these shenanigans so that you don't have to focus on that, okay? But bottom line is, anytime you see this rate, just know it's being compounded daily, but it's going to be paid effectively at the end of the investment period, okay? I hope that is clear. You're welcome, guys. I hope I was recording. Let me just confirm. Oh, yeah, yes, I am. Okay. Can such companies cheat on that value? Maybe adjust it kidogo? Yes, they can. You know, yes, they can. Yes, they can. But the thing is, as it's a public offering, what the company has to do is now disclose in their financial statements what it is that they had done. Okay, they have to disclose. So this is how we invested, these are the returns that we got, but it's fairly easy for them to tweak it a little bit when the performance has not been as good. And we still have a lot of development as a market to get to that place where there's full disclosure. Okay, so let's move on to the next thing. Yo, it's almost 9. Let me finish this thing, guys. All right, most important thing for everyone who's in here right now. All right, most important thing, when to invest and what do you consider as investment criteria. All right, so the first thing is, as usual, as we said, your risk profile. For the ultra conservative, the money market fund is the route. For the aggressive, the equity fund is the route. All right, the alternative investment fund is the route. Let's say like a REIT. You know, a REIT simply means a real estate investment trust. Okay, so it just works like a fund. So you have different real estate portfolios with different trends. You know, let's say if I have 4 apartments at different locations, one in Syokimau, one in Kilimani, one in which is the other place, Kasarani, and one in Eastlands, let's say Umoja. So if I want to invest in real estate in these areas, so if I have this fund, I'm able to pull in my money over there that is used to construct these places, or let's say be used in maintenance, you know, and any return that this real estate property generates is given back to me as the investor, right? So the difference is only the asset that is being invested to, but the procedure is usually the same, right? So the second thing, what to consider in investing in mutual funds is, for you as a person, is your savings. You know, do you want to build an emergency fund? Are you saving for different events like a wedding, a vacation, a large purchase? You know, say, let's say if it's a car or a piece of land. And then when you have little understanding on active investing in a portfolio management, where you don't know what you ought to do, so you just get a fund manager to do that work for you. All right. And then the fourth one is exposure to different investment opportunities that can hardly be accessed by retail and individual investors. For example, if a company like Bidco Africa wants to raise like 10 million shillings to purchase some inventory. Number one, Bidco is a private company. So for you as a retail investor, you won't even know that they have such kind of an offering. But for the fund manager themselves, they know that Bidco is looking for some cash and they're going to pay around 6% in returns. So they will be able to pull that fund from us as the 18 investors over here in this platform. All right. And then after that, they're now going to invest into that debt that Bidco is offering, and then we get returns. And if I wanted to do that by myself, I wouldn't have gotten that opportunity. Okay, so that's what you consider when it comes to mutual funds. If you forget everything, remember these criteria. You look at your risk profile, you look at your savings or your purpose, all right? You look at your understanding of investing and investment assets, and then you look at the exposure to opportunities that you cannot access by yourself, right? And then what you now need to do for you to start out in investing in mutual funds is identifying your preferred investment manager, and we look at that criteria on the next slide. And then the usual, your opening requirements. And for this, you only need your know your customer documents. It's not necessarily a requirement for you to have a CDS account, a central depository account when investing in mutual funds, let's say money market funds, all right? And then you also look at your investment objectives. Why do you want to invest in this mutual fund, and how you, let's say, your risk profile fits into that. And then the last thing is you start your investment journey with the agreed upon deposits. And the good thing about money market funds is that you can deposit at any time as long as it's the minimum deposit requirement. Okay, so yeah, I'm really trying to keep this thing as simple as possible. Okay. The next thing is how to invest in mutual funds. So criteria to consider when choosing an asset manager. And I think this is the most important thing, because there's someone who had a question for me, which was, so which money market fund will you recommend? You know, and you'll find guys who will tell you, oh, do CIC, or do Saiton, do Sanlam, do Britam, you know, just different companies. But you're asking yourself, so which is the most important and why? You know, so what do I really look at? It's not just a word of mouth, but for you as a diligent investor, number one, you'll have to check the investment performance. How have their rates, those numbers we were doing over there, performed in the last 3 years? So let's say, for example, have they been at a consistent 9.5%? Have they been at a consistent 9.7%, 10.2%, you know, at the end of each financial year? All right. The second thing is assets under management. Has their assets under management been increasing year after year? So let's say, for example, if we see that Sanlam East Africa has started out, let's say, for example, in 2019, they had like 500 million assets under management. 2020, they had 674 million assets under management. 2021, they had, let's say, 900 million assets under management. You can see that that is it's a preferred tool, you know, for investors to invest in money market funds. So that's something you also look for. And then the third thing is the fund structure. So how is the fund structured? Is it a money market fund? You know, what are the different mixes of asset allocation that they have used for that fund? Okay. Keeping it simple again. And then all this detail, the first three, it's found on the fund's financial statements, which we'll talk about in equity investments. All right, so the next thing is opening requirements. What are the opening requirements? You know, so let's say there's one, for example, Nabo Capital, one of the companies known as Nabo Capital, has an opening amount of 1 million for their money market fund. All right. The other companies like Zimele Asset Management, that you can start off with as little as 100 shillings. So if you're building that practice and that diligence of investing in money market funds, you can pretty much check on which offers low opening requirements. And most companies range between 100 shillings, 500 shillings, 1,000 shillings, and 2,500. It pretty much depends, but this is now where your due diligence comes in. Okay. And then the last thing is your user experience. How frequently can you withdraw money from your account? There are some which they won't allow you to make withdrawals, let's say once every month, once every 3 months. There's some which you can do so daily. Okay. How long does it take for you to have withdrawn funds deposited into your account? So let's say if I make a withdrawal today, okay, today being Wednesday, how soon will I get that cash? Will I get it on Friday? Will I get it next week on Monday? Or will I get it within a few minutes after I've made the deposit request? Okay. And then you also check their online portals where you can easily monitor your investments. All right. So I want to show you guys something. You know, at times you might be asking yourself, so where do I get to know which companies to invest in, or which companies offer these money market funds? All right. So if you go to your daily newspaper, and over here I have the Daily Nation, on the stock analysis page, you'll have your unit trust segment. Can you guys see it? Let me change the color. Can you guys see this? Please let me know in the comments. All right, so for example, you can see, you remember as I was explaining the daily yield. So there's this daily yield, all right? And eventually, as they aggregate it towards the end of the year, there's this effective annual rate, all right? For example, if it's the Britam Money Market Fund, you'll find that the effective annual rate is 8.51%, all right? If it's the Sanlam Pesa Market Fund, this one over here, you'll find that their annual rate came to is at around 9.52%. Okay, if it's Saiton, you'll get to see that they're at around 10.5%. Okay, if it's NABO, all right, the Kenya shilling, you'll find that it's at 9.7%. Okay, let's look for another one. Looking for a money market fund. Which money market fund can you guys see? Okay, this is Apollo money market fund, all right? They are currently at 8.95%. Okay, so for you as the investor, you're asking yourself, so how do I choose these different funds? Remember, number one, you check the effective annual rate. What do you stand to gain? One might give you 9.7, one might give you 8.95, one might give you 10.5, one might give you 9.52, one might give you 8.51. You see, they're all within the same range. Number two, what are their assets under management? Does Britam have 1 trillion shillings or 100 million shillings in their management? Okay. Does Sanlam have 500 million? Does Saiton have 700 million? That's something you look at. Okay. And then the other thing that we've said is you look at the different investment criteria, the different investment criteria that they have chosen. Okay, and also something else that I want you guys to notice is if you check keenly, you can see something like a bond fund. I don't know if you guys can see it. Can you see where I'm highlighting? Okay, so this is a bond fund. So if you want to invest in different bonds in the secondary market, you can get this fund. All right. If you want to invest, let's say, for example, in equities, in stocks, that is, you can see that there's a whole portion over here for equity funds, and you can see the rate at which one can buy 1 unit. Okay. So where you see that they have not, and you can see that this is where they've cut the list. Okay. And so this is where it's starting out. All right. So if I want to invest, yes, they do, Marianne. They do. It's found on the financial statements. Each and every company releases their assets under management to the public. I think if we have enough time, we can go through it in just a minute. All right. So as you can see, guys, so you have an equity fund. Okay. So let's say, and you can look at the rates. So let's say, for example, if CIC offers that you can buy 1 unit at 7.69 shillings, okay? Britam, you can buy, let's say, an equity fund at 120.92 shillings for 1 unit. So these are the different things that you look at. Remember the guys who were at the middle, the cautious stroke moderately risk investors, all right? You remember the balance funds. So here's that list of different balance funds. So you have an Amana balance fund, Zimele balance fund, an Old Mutual, Sanlam, CIC, Britam, African Alliance, okay? And you'll find the different prices for those different funds. So with 1 unit in that fund, you can buy it at 20 shillings for African Alliance, you can buy it at 152 shillings for Britam balance fund. I hope that is clear, okay? So also, apart from the Daily Nation, you can also check on the Business Daily, all right? And so when you look at the Business Daily, for them, they're usually well condensed, okay? So the better one is usually the Daily Nation when it comes to getting this information. right? So over here you can see, now the different money market, funds that are currently existing, right? So for example, if it's okay, for your question, Deno, does it mean that Britam has more better? Not really. It's pretty much just a valuation. All right. So let's say, for example, what it means is, let's say I have this pool, Britam, which is at 120 per unit, okay? But you'll find that their return will basically play at around 9 or 10, okay? You might find that for this other company that's at 8 shillings, you might find that their return is at around 11, all right, percent. It's just the same way as stocks operate. And even you can just look at that on this list over here. So let's say, for example, we see that which one? Okay, for example, let's look at Limuru Tea. All right, so Limuru Tea currently trades at 320 shillings. Okay, and then we have a company like Kapchorwa Tea that currently trades at 89 shillings. Okay, so does it mean that Limuru Tea has better returns than this one? No. You might find, you might find that there are different factors that affect that unit price, but it doesn't necessarily mean that it's based on the fund itself, okay? And when you look at equity investments, you'll be able to see the difference between, like the intrinsic value of a security and like the intrinsic value, the inner value. See the way we usually say that mina inner beauty, something, or if you allow me to use that, the intrinsic value of a security and the market perception, non quote unquote inner beauty and outer beauty. Okay. Yeah, so that's how it basically works. So it doesn't mean, but what is required now of you as an investor is a diligence when it comes to researching and actually knowing how they're performing. And this is usually also found on their financial statements. Okay, again, back to the money market fund. So you can see Sanlam has an effective rate of 9.59, Saiton 10.52, African Alliance 7.3%, Zimele 9.19, whatever, you get the gist. Okay, also remember something else: inflation. Always be alert of the inflation rate. Okay, so when you're looking at the overall inflation rate, you can see that currently right now at November 2021, it stands at 5.8%. This is also an annualized rate that inflation this year increased at 5.8%. So yes, Daniel, that's actually it. All right, so you guys, so you realize, let's say if this year inflation was at 5%, and my money market is at, let's say, 9.91%, you see that the increase in value is the difference between the rates that you've gotten and inflation, okay? Because you have lost value due to inflation according to the inflation rate, but above the value that you have lost, you have still made a return on that. And that is where investment returns are actually made. Okay, so I hope everything about the unit trusts are well clear. All right, so remember, again, the fixed income fund, which we'll talk about when we come to fixed income, which I really don't know if we'll be able to do that today as time is so much spent. But you can see that you have different bond funds. So let's say, for example, I'm looking to invest in different bonds. So I'll go to Sanlam and say that I don't have, let's say, 150,000 shillings or 200,000 shillings to buy a bond, but I have 30K, all right? So I have 30,000 shillings. How can I build a bond portfolio with 30,000 shillings? So you'll go to Sanlam. They help you buy into a specific bond fund that meets your needs, okay? And eventually for your portfolio, you have now a bond fund. Okay, so that's how they pretty much work. So that now when you have the full amount, you can be able to buy the individual bond by yourself. Okay, so I just wanted to show you guys this example, and I really hope it's clear. If it's not, please let me know so that I see how to effectively explain. Okay, yeah, and for those who are asking about commodities, remember what I was telling you about commodities. So you can see here, different commodities listed, you know, dry maize, passions, beans, bananas, dry peas, mixed beans, okay? And even when you look at other commodities over here to the right, you can see that there's the gold commodity, all right? There's the oil commodity, you know, there's copper, there is wheat, there is tea, right? So it's just a brief example. Okay, so I hope that is clear. For those who asked about where to get the details on the, for example, asset management, you can just do Sanlam, you know, money market fund financial statements. Right, and so it will actually bring you to this page. All right, let's see if this one will get to open. So I'm just really trying to show you guys how to navigate through these details so that it's easier for you, right? When you're making these decisions come 2022. All right, so you can see Sanlam Unit Trust annual report and financial statements 2020, and a lot of details. Okay, so for example, you can see that, where's my annotation? Right, so you can see that they've said that this is a fund performance for Sanlam's unit trust for the past 5 years, right? So 2016, the highest yield was at 19.84%, which was really good, and 12.12 for 2017. For 2018, it was at 8.62. 2019, it was 9.82. 2020, it was at 9.56. All right, so you can see that it started off, let's say 2016, it was very high, and then it dropped all the way to 12.2, and then it dropped again all the way to 8.62, but picked up to 9.8 in 2019, all right? And the highest yield came to around 9.56 in 2020, which was also a drop, but a minor drop. All right, so this is something that you look at, and also the lowest yield. So it's pretty much an aggregation of how the fund has been performing throughout the year, but this is what matters the most. Okay, so the next thing is income distribution. This is now the profit that the fund has been generating. Okay, so for example, you can see that it's been increasing. I'm looking for my annotation tool. Okay, so it's been increased from 155 to 217. Profits decreased to 132. Profits increased to 154. Profits increased to 383 million. Okay, all right. The other thing that we were talking about, which was the asset under management, is now the total value of the fund. Okay, so if we look at 2018, the assets under management were at 1.698 billion. Okay, 2019, it increased all the way to 2.653 billion. And 2020, a significant increase all the way to 6.155 billion. So it can actually show you that there's a positive market sentiment with regards to Sanlam's money market fund when you see their assets under management increase. And even when you compare that to, even in as much as you compare that to their fund performance, which has been relatively stable, you can actually identify this to be a favorable investment tool for investors. I hope that is clear, right? Because the other thing for you as an investor is you now have to dive into understanding these details, you know, these funds and everything, you know, the financial statements. It's a lot of work, yes, but I can assure you that this is the work that filters the winners from the losers. Okay, all right, so let's move on to the next thing. All right, guys, time is far much spent. I don't know if we'll be able to cover everything, but I hope we'll be able to move a little bit quick on this one. All right, if you have any questions, please let me know, and I'll be glad to explain it to you. Okay. All right, so moving on to the next one. So brief recap. So now we are in stocks, all right? We're here understanding equity in instruments, which is one of the major things that we wanted to cover tonight. and I'll try to do it in 15 minutes. And I have a request. I don't know if it's okay with you guys, because we still have bonds to cover and we have around 15 minutes remaining. So please let me know on the chat box. Is it okay with you guys if we end it at equity investments and get to do bond investments at a later time? And at a later time, it might mean if we get to log in again for us to do it, or I just get to record myself doing that session and then just share the link, okay? And if not, would you mind, you guys be willing to extend a little bit into the night so that you're able to cover it? Please let me know, okay? Let me know if we extend some time so that we cover everything tonight, or if we get to cover investing in bonds at a later time. Okay, so please let me know. Okay, extend, later date, extend. All right, so please let me know as we continue covering this material. All right, so brief recap. So now we're talking about stocks, and this is an interesting one because I also had planned for us to do a live purchase of stocks and just show you how that works. Okay, so you can extend and share the recording. All right, thank you. The recording is still present. Okay, all right. So brief recap, primary markets, remember what it is you said. You remember our car example, DT Dobby. DT Dobby is considered as a primary market for new Mercedes-Benz, okay? And the secondary market will be the dealer along Ngong Road who is selling them Mercedes-Benz that was initially bought at a DT Dobby, okay? All right, so the next thing is capital markets. Capital markets, remember what it is we said, that this is markets where maturities of investments will last over 1 year, okay? And money markets are where the maturities of these investments will not take longer than 1 year, all right? Okay, so there's a later date, majority of guys are later date. Okay, all right. So let's finish up on equities and then we agree on how to go about it. Okay, so our company in focus for our equities class will be Safaricom. Yeah, it's pretty much just a very simple company to understand, a company that you all use. So even as I get to explain some certain details, we'll be able to focus in on what's currently going on in the market. All right, so I also have financial statements, Safaricom's financial statements with me, which we'll be using to reference at different times. Okay, so the next thing is, so this is one of my most favorite quotes by Benjamin Graham. He's the author of a book known as The Intelligent Investor, and he says that investors should purchase stocks like they purchase groceries, not like they purchase perfume. And what does this mean? It basically means that you need to have an extra level of diligence, first of all, when it comes to groceries, you know, as compared to perfume. And then the other thing is also considering stocks as necessities, as important necessities. You're very specific. Has this, let's say, for example, banana ripened well, okay? And not just looking at it as a perfume, you should be like, yeah, I can take the other one. I can pretty much take any which works out, okay? So it requires a very serious level of due diligence when it comes to selecting stocks, okay? And we look at different ways of investing in the stock market. One of them is what it is we covered previously, which is now the mutual fund. So let's say you'll have a stock mutual fund, okay, but we'll get to explain that later on. All right, so we're going to look at the purpose behind equity instruments and getting started with stocks. All right, so with this, we start off with the definition, which is basically And equity represents the shareholder's stake in the company that is identified on a company's balance sheet, which is pretty much your assets less your liabilities, okay? And the second definition is a stock or any other security representing an ownership interest in a company, okay? So all details sorted out. I'm looking for my annotation too. Can't see it. All right. So if there's something that you guys will have to understand when it comes to equity instruments and stocks is the accounting bits, you know, the accounting principles that currently exist, but it's not as necessary right now, but it's a major portion of that. Okay. So for example, just to make it as very simple, a company has 3 financial statements. It has an income statement, okay, so which is basically your profit and loss. So it just shows you, this is where we made money, this is where we spent money, and this is how much we retained, okay? The second statement, financial statement, is your balance sheet, all right, or a statement of financial position. So what basically that means is it shows you, so as a company, this is what is ours, and this is what is not ours, okay? And so by this, I mean what is ours is the assets, okay? What is not ours is the liability and the equity, all right? And this equity is also known as capital, okay? So this is what we own. If for example, if I have my own, let's say financial statement, my own balance sheet, let's say my asset is my laptop, all right? My liability is my borrowed, let's say tablet, all right? And let's say some cash that was given to me by my friend of around, let's say 50,000 shillings. Okay, so that's how we look at it. So the income statement, where you made money, where you spent money, and what you retained out of it, okay? Balance sheet is basically what you own and what is not yours, all right? And the last one is cash flow statement. And the cash flow statement basically means this is how cash moved from point A to point B within the business. And this is how much cash you've remained with, all right? This is very important. And I'll come to show you where, but it's a good understanding for you to understand the first statement, okay? And in any simple accounting lesson, your assets over here will equal your liabilities and capital or equity. But that is not our focus tonight. It's just to give you a good example, glimpse of what it means. And then the other one is a stock or any other security representing an ownership interest in a company. Okay, and so that is what Safaricom have done. So they floated shares. So it means that for the 13 of us in here, you'll get to have someone, let's say, own a certain segment of all the stocks that have been issued. Let's say if it's 1 million, all right, let's say 13 million, you'll get to have, if all these shares were floated to each and every one of us, we'll let's say have like 1 million shares each, all right? So 1 million, 1 million, 1 million for the 13 of us. And that is what it basically means when we say that it's a security representing an ownership interest in a company, okay? So out of this huge pool of 13 million shares by Safaricom, for example, the 13 of us get to have 1 million shares, which definitely means that there might be an external party which will have the remaining 3 million shares, okay? So I hope that's clear. So the next thing is, let me try and rush a little bit. The main purpose of equity instruments is to raise capital for businesses, all right? So how that basically works is Safaricom wants to, let's say for example, they want to enter into which country? Let's say Egypt, now that they're in Ethiopia, all right? And they realize that within their financial capabilities, they don't have enough cash to enter into that market. So what it is will they do? Let's say, for example, they want to raise 5 billion shillings to enter into that market, okay? So what this Safaricom will do is they will float shares that represent an ownership in the company that is valued at the 5 billion. All right. So this is us. Let's say this is the Fitnances investors group. All right. And so Safaricom, they want to raise, SAF wants to raise 5 billion shillings, okay, to enter into the Egyptian market. All right. So what they'll do is they will float these shares onto the public through a process known as an IPO, which I will talk about later on, to the public, and us as the Fitnances investors group, we will get to buy these shares for us ourselves. Let's say we'll buy a valuation of 3 billion, which will be quite good to have a group of 13 guys own all those shares, you know. So that is pretty much how they work, right? So when we have the shares, so we have an ownership in Safaricom worth 3 billion shillings. Let's say they floated 1 million shares. All right. And so for the 3 billion shillings, that comes to around 60%. So it basically means we own 600,000 of those shares as Fitnances investors group. Are we together? I hope that is clear. So what shares we'll have the shares to our name, but now Safaricom itself will have 600,000 or 6 million of our cash, or 3 billion, sorry, 3 billion of our cash, all right, for their fundraising, okay, for entering into the next market. So that's pretty much the most basic understanding of how shares work, all right? And so what happens, and what it is that we get to see later on is how they're traded. But before we get to that, we look at the main characteristics, which is high risk, high reward, all right? And so under this, we have the next one being the liquidity of the stock being dependent on how frequently the stock trades, okay? For example, just to show you a very simple example to see the difference between a liquid and an illiquid stock. If you can see my screen, I'm sharing the business daily stock list. This is today's business daily, right? So you can see, if you want to know a stock that has pretty much been quite illiquid, you can tend to look at the 52-week low price, okay, and the 52-week high price, right? So for example, a company like, let's say like Limuru Tea, all right? Let me get my annotation too, so that you get to see it. So Limuru Tea, let's say for example, had a 52-week low of 260 and a 52-week high of 360. But if you look at the previous rates from the 24th all the way to the 28th, which is a difference of 4 days, the stock hasn't moved a bit, right? So it shows that it's quite illiquid, right? And then also you can look at the traded volume, and you can see that there's no volume that has been traded, which means that most guys do not get to buy it, all right? So if you look at other companies, let's say a company like, let me look at the common bank stocks, which are pretty much liquid. You'll see that, let's say for example, for equity, in between for a difference of 4 days, the stock has been moving up and down, all right? And you can see that the trading volume has been around 89,000 shares which were traded, okay? So this is why you check those little nitty-gritties like liquidity. So if you want to see a highly liquid stock, it means look at the trading volume. You'll see KCB was at 338,000, all right? Nairobi Business Ventures was at 286,000, okay? And a liquid stock will be Standard, which was traded only around 100, right? Scan Group, a bit liquid, 71,000. So these are the little nitty-gritties that you just get to check on when you're analyzing a stock to buy, okay? So our time is almost up. I think we'll just finish up on equities and then get to see how to go about bonds later on, because it's also quite extensive. Okay, so the next thing is stocks are categorized into different criteria according to its dividend policies, all right, company fundamentals and operating industry. So for example, when you say dividend policies, it means you'll find that there are different stocks that have different dividend policies. Let's say if this year we made, let's say as a company, Safaricom made, let's say 100 million in profit, okay? And the dividend policy says that 80% of this is going to be paid as dividends, all right? So you'll see that it's a high, let's for example, a high dividend company. And if another company, let's say something like Centum has a dividend policy of 20%, you'll find that if they made the same 100 million as Safaricom did, they will only pay 20% as dividends, okay? But we'll get to explain how dividends work later on, okay? So you don't have to stress about this right now. The other thing is company fundamentals, which we'll talk about later on, and also operating industry. So let's say, for example, Safaricom is in the tech industry, Centum is in the investment industry, Equities in the banking industry, okay? And you can clearly see that difference. You can clearly see that difference on this list, all right? So it's broken down. So there's the agricultural, automobiles, banking, all right? Commercial services, construction industries, all right? And yeah, energy and petroleum, insurance, investment services, manufacturing and allied, telecommunication, real estate investment trust, which I mentioned, and an ETF, a gold ETF, okay? So, but that's not our focus right now. So, and then the other thing is that stocks grant the shareholder right to participate in company operations, such as voting rights. So in the event Safaricom wants to, for example, hire someone else apart from Peter Ndegwa, you have the right as Safaricom's shareholder on making that decision, all right? The decision lies in your hand. So the next thing is we have types of shares or stocks, okay? And we have two common ones. First one being preference shares and the second one being ordinary shares, right? So a very brief example of what this actually means is for preference share, these are shares of a company stock. Dividends are paid out to shareholders before. The key word over here is before. Common stock dividends are issued, okay? Preference, you know, like you're preferred to the common investor, okay? So for example, if we've made, go back to our Safaricom example of 100 million, and we are paying out, let's say 80 in dividends, you'll find that, let's say, for example, the preference shareholders will be paid first, and let's say they have a 30 million valuation. So they'll be paid first, right? And then after the preference shareholder has been paid, now the common shareholder is now paid, okay? So the thing with preference shares, it acts more like a debt, you know, that whether you make a profit or not, you will have to pay me my dividends at the end of the year, right? So it's a preference, so it has a higher value compared to a common shareholder, all right? So that's something to be very cognizant about. And most of the times when you buy shares on the NSE platform, you're pretty much buying as an ordinary shareholder, okay? So you can come in as a preference shareholder, but trust me, you won't buy 100 preference shares, you know, or valued at, let's say, 5 shillings. It won't be of any value. It's usually taken up by guys with some strong financial muscles. And on the flip side, the good thing is actually being a preference shareholder is way better than an ordinary shareholder, because you're paid first, you're paid regardless of whether the company makes a profit or not, okay? Because as an ordinary shareholder, you're paid the last person. So after all debts have been settled, all preference shares have been settled, then is when you now receive your dividends, okay? And in the event the company makes a loss this financial year, you won't get any dividends because you are not a priority. How do you become preferred? So what the company will do is they will, at times it's not as open to the public as we want, because what's allowed to the public is excuse me, is the ordinary shareholder, okay? So what is the company will do? Let's say, you remember a Safaricom hypothesis where they want to enter into the Egyptian market. So they need a certain quick amount of cash for within a very short period. Let's say they need like 6 billion shillings, all right? That they need it urgently, and they're not certain that they'll be able to go through, let's say, an IPO process to raise that cash. So what they'll do is they will identify, let's say, for example, a group of investors, right? Pretty much at times institutional investors or even individuals who have the financial muscle, and they will give them these shares, and they will tell them, you know what, you want to raise 6 billion, let's say in 3 days, you want to purchase some equipment for us to enter into this market, that it's a requirement. And what this will give you is a preference share of this return each and every year, and regardless of any eventuality in the market, whether we make a profit or not, you are guaranteed that you will receive your dividends, okay? So most of the times when it comes to preference shares, it's usually floated to a certain niche of investors who pretty much have the financial muscle and capability of being able to invest such large sums of money, okay? So that's why you'll find that sometimes most of the preference shares are let's say like companies, you know, let's say like we are 5, let's say the 11 of us, you know, and we bring in like around 800 million shillings each, you know. So when we bring that together and we form that as a company, eventually you're able to float this to Safaricom, or you can still do that, but they might have restrictions on how that goes about. Yeah, so preference shares is usually for the strong capacity guys, financially strong guys, but it's something that I usually say it's not out of reach. It's just growing in capacity, okay? And you're preferred also over the common shareholder. But anytime you see common shares being traded, it's pretty much the ordinary shares, all right? Okay, I hope that was clear. The next thing is, you're welcome. Right, so this is an example of Safaricom's share breakdown for their last financial year, which was 2020. Okay, so you can see that the number of shares that they have is 40 billion actually. All right. and the valuation of ordinary shares stands at around 2 billion. Okay. And they also have a share premium, which will not dive into it right now as it's a bit complex. But you can see that they've said that the authorized share capital of the company, which is the capital they received. Remember when we're doing the accounting bit, you know, your assets, your liabilities, and your capital, okay? So the authorized share capital of this company is valued at 6 billion, and it is divided into almost 2 million, what's this? Almost 200 million ordinary shares, okay, but 1.19, all right? Ordinary shares of 0.05 each, and 5 non-redeemable preference shares of 4 shillings each, right? So this is as at that time when it was being floated, but you'll find that the market value is definitely higher than this, as compared also to this 0.05 each. So if currently Safaricom right now is at 38 shillings, you'd find for someone who had the initial shares, portion of ordinary shares from the time Safaricom came into inception, you'll find that they have this capital gain of 38 shillings up from 0.05 if they choose to sell their shares. And it's a wonderful capital appreciation. of the initial investment, okay? And so here's a breakdown. Issued share capital comprising of 40 million shares, you know, and and when you see this, where it still remains the same number, it means that they have not floated any new shares. So this is what is being traded in the market. All right. So ordinary shares with a par value, which is face value, you know, or just at the normal value of 0.05 shillings each. Okay. So it's usually required for you as the investor to get to learn more about this accounting concept, because this is purely accounting. Okay, so how the share premium works, how the ordinary share works, and how the preference share works. But our main aim for this session was just to show you an example of how an actual company has broken down its shares. All right. So the next thing is, all right, stocks on the public market. We're almost done. We're almost done with equities. So please hold on. I know we've gone a little bit much into time, but I hope we'll be able to clear quickly. So stocks on the primary market, you still remember our DTDOB example and our new Mercedes-Benz S-Class. So Mercedes-Benz wants to bring the new S-Class model into the Kenyan market, all right? So that's the primary market. It's the same thing as stocks, right? So Safaricom back in 2008, when they listed publicly for the first time, they had to go through the initial public offering, which is known as an IPO, okay? And so their aim was to raise funds for the company for different purposes, which is found on a document called a prospectus, okay? So it's usually done in conjunction with a consortium of professionals such as investment banks, law firms, financial regulators, right? With a set of requirements being given to the public before it lists on the Securities Exchange, you know, and the shares of the company are introduced formally to the public through this process, right? So this is not something that you're able to cover right now, as it's very intense and it's quite a lot, and especially understanding how you can be able to be participate as an investor in any IPO, and that we cover it in our Fitnances Academy, which I'll talk about at the end of this session, all right? So Safaricom, it was a private company before, but in 2008, they participated in an IPO where their share traded at around 5 shillings, right? And so for someone who invested as an investor back then 5 shillings, and right now the share valuation is at 38, you can pretty much consider that increase in value over this year's their capital gains, right? Which I'll talk about later on how you make money in the stock market. All right, so this is something to consider. So it's usually advised, or if you have the capacity, especially when a company is floating an IPO and it has good fundamentals, it's a stable company, if you participate in that IPO for the long term, if you give yourself, let's say for example, like 10 or 15 years, you're pretty certain that if it's a stable company in a stable business environment, the value of its share price will continue rising, right? And when you decide to sell 20 years from the time you bought the IPO, you're guaranteed that you'll have made a capital gain, all right, out of the amount you had initially invested. So that's how an IPO usually works. And it's a process that involves banks, investment banks, and they now take these shares, you know, and offer them to the public, and then guys buy, and then they get the cash back to the company, and now the shares now continue trading in the secondary markets, which I'm covering in the next slide. All right, so that's the primary market. I hope it's clear. Please let me know if it's clear or if you're lost so that I get back to it. Okay, so the next thing is now the secondary market. You remember what it is explained. So now the secondary market is the initial stocks have been sold. All right, let's say they were sold at 5 shillings for Safaricom. And as the company grows and the financial markets continue trading, more investors find value. Due to forces of demand and supply, you'll find that the price now continues increasing or decreasing depending on the macroeconomic factors. So what happens over here is in the secondary trading of these stocks in the market, it's done now through an organized marketplace known as a securities exchange, or what you usually know, for example, here in Kenya as a Nairobi Securities Exchange or the NSC. Okay, so you'll find that this is where now the secondary trading is done. So if Safaricom floated around 40, as we have seen, 40 million shares back in 2008, and they have not increased any, it's still the same 40 million shares that is being traded in the market, all right? But now the valuation has been increasing ever since. I hope that's clear, right? So for someone who bought it in the primary listing, they bought it at 5 shillings. But for us who are trading it in the secondary market, we'll have the variations between, let's say, 20 shillings to 40 shillings per share of the 40 million. Okay, so that's how, in simple terms, secondary trading of stocks happens in the securities market. Okay, and so this can also be done in other marketplaces known as over-the-counter markets, which are not pretty much open to the public. It's usually tied down towards dealers and institutional investors, which are which as I've said. And security trading of bonds is frequently done in OTC markets. All right. So the other thing is it's where the buying and selling of securities takes place, and this is done through financial intermediaries. And I will explain what these guys do. All right. So that's pretty much it for the secondary trading. And you'll also get to do as an activity the final, like, how do you get to navigate through the NSC platform, the online NSC platform, right? And actually get to buy some Safaricom shares, just to show you how that is done. Okay, so the next thing is now we continue to look at the financial intermediaries. Who are these guys? It's an entity that acts as the middleman between the two parties in a financial transaction, right? So, and I'm pretty much sure that either you've heard of either of these investment banks, right? So you've either heard of Diane Blair, all right? You've either heard of Faida Investment Bank or AIB Axis, and pretty much other banks like Sterling Capital. There are quite a number of investment banks, okay? Excuse me. And so what these guys do, especially in the secondary market, they are the ones who can broker or buy or sell these securities for you, or give you the platform to do so. All right, and I'll explain to you how that process is done. Okay, so if we are the Fitnances investment group, we want to start investing in equity securities, we will need these banks here with us at the middle to help us navigate through this. All right, so the bank itself will give us, for example, the platform. You know, they might give us advice if we don't know what it is you're doing or what it is we actually want. All right, they will give us, for example, the funds that we were talking about, the equity funds. You know, and so the work is basically to just understand what we want and just take our cash, and then out of the agreements that we've made, which, if you can remember the investment policy statement, they now get to invest on our behalf according to the criteria that we have set. Right? I hope that is clear with regards to financial intermediaries. So, but I'll explain more on how to get to use the services. Okay, so the next thing is now getting started in share investing. So which are the different routes you consider? So the thing about shares is, and we'll look at that slide later on. I don't know if it's over here. Let me just see. This is something else. Did I include it? All right, yes, here it is. So, so how do you make money in the stock market? You make money through two ways. First of all, you make money through capital gains, or you make money through dividend income. All right, and we'll calculate. I'll show you how dividends are calculated. I remember there was someone who once argued with me, telling me that Safaricom pays dividend peanuts, you know, and yet they're a very stable company, but they didn't really understand how dividends are calculated. Okay, so how do you make money? This is the most important part of this section, if I'm not wrong. So number one, dividends. Number two, capital gains. So dividends is basically that portion of the company's profits that you get each and every year that is agreed upon by the company's board of directors. Okay, and then the second thing is capital gains, which, let's say, for example, if we bought these shares at 20 shillings and we sell it at 65 shillings, we have a capital appreciation of 45 shillings. All right, and so if you had 1 million shares, it pretty much means that you have made 45 million shillings, you know, invested 20 million shillings, and over time, let's say if it was a duration of 15 years or 10 years, and the stock was valued at 65 million shillings, you sold it at 65 and you made a profit of 45 million shillings. Okay, and so you might find that out of this 1 million shares that you have, so that I help you understand dividends, all right, you might find that the company has been paying dividends of 5 shillings per share every year. Okay, so every year you've been making 5 million in dividends. All right, and you've been making that, let's say the company has been paying dividends consistently of 5 shillings per share. All right, so if you did that for 15 years, all right, it means that over 15 years you have been making, so you made 75 million. All right, so I hope you can see how dividend income works. All right, so you made 75 million plus, and let's say if you never touched this money, it was just getting, let's say, into an investment account, and you sold these securities at 45 million. All right, you made a profit of 45 million. So it pretty much means that out of an investment of 20 million shillings initially, if you add these two returns, you have made 45 plus 75, and you have made a clean 120 million shillings. All right, so that's how you make money. Right, so the more stocks you have, the higher the valuation. That's what determines how much you're going to make. Okay, so if this person never touched their dividend, excuse me, the dividend income, so you'll find that they made 75 million in dividends for 15 years, and after the 15 years they sold their position for 65 million to make a 45 million shilling profit. Right, and even if you adjust this for inflation, you might find that now the current valuation might be at around 102 million shillings. Okay, so that's how investors make money, simply make money in the the securities market. Right, so these other slides, I'll just go through them quickly. So there are different dividend capabilities when it comes to stocks. Right, so the first one is growth stocks. Right, so growth stocks basically means that they're expected to outperform the overall market over time because of their future potential. So let's say, for example, allow me to use the US market. A company like Facebook is considered to be a growth stock. All right, that the company has a high usage, you know, it's pretty much within the social ecosystems, but their financials are yet to match up to their level of growth. Okay, simply because they're investing their money in long-term projects that are expected to pay in later years. All right, so if you find such a company that has an increase in their valuation, it shows that it's a growth stock. All right, a value stock is pretty much a stable company that has been there in existence for a very long while. So let's say, for example, if you guys have ever heard of a company like Walmart, Walmart is considered to be a value stock because it's pretty much for each and every company, there's usually a growth cycle. Okay, and so for a company like Facebook, it's on this high steep section of growth, you know, so it's considered a growth stock. But Walmart is on the low growth side. It's considered quite stable, quite plateaued. They've already matured. Okay, so that's considered to be a value stock, that you are certain that this company, for example, will be paying consistent dividends, consistent profitability, or something of that sort, right? But we can't be able to cover that right now as we don't have time and it's quite extensive and it'll be too much information to take in. Okay, so the other thing is dividend stocks. So dividend stocks pretty much mean stocks that have high and consistent dividend yields. Okay, so remember our example where we said that there was this company that was consistently paying let's say 5 shillings, 5 shillings each and every year as dividends per share, right? So that's compared to that market when other guys are offering at 0.92 shillings, all right? You might consider that to be a high dividend stock, okay? And there's a way you calculate it, which I'll just get to touch a little bit on it, but we won't go into details. All right, so the next thing is also non-momentum stocks, and these are stocks that have been appreciating in value for the past couple of years, like our company in focus, Safaricom. All right, so the next thing is getting started. So where do you start? And I also know that this is one of the major questions that each and every one of us has. Where do you start when it comes to share investing? And so there are 3 main routes that any investor can consider. All right, so the first one is the financial intermediary route. All right, and the financial intermediary route is the most basic. Okay, it's pretty much the most basic, where you just show up and say, I want ABC, you give it to me. Okay, so let's say for example, if you, Caroline, want to start investing in the shares market, so what it is you'll do, you'll go tomorrow morning to FIDA Investment Bank or Dan Blair Investment Bank and tell them I have, let's say it was my birthday this Christmas, and someone gifted me with 300,000 shillings and I want to invest that cash into the securities market. So Dan Blair, what it is they will do, they will get to do an assessment, which I showed you guys, of your investment objectives and your constraints, and they will see what will be a good mix for you together with your risk profile, right? So they will do all the due diligence. All you just have to do is open the account, deposit the funds into the accounts, and what they'll just do is give you a letter notifying you that, or an email notifying you that they managed to purchase the securities at these prices, these quantities, and yeah, you can just be free to monitor your investment account. That's the financial intermediary route. And the good thing with that is you don't have to carry out any stock analysis. The intermediary does that for you. The broker does that for you. And all they just have to do is also just assess your current situation and goals, and out of the expertise, give you the best mix of stocks to invest in. Okay, I hope that's clear, guys. And then the next one is the mutual fund route, right? So this is what it is I explained with the equity funds, where now you purchase a portion of a mutual fund through a stockbroker or an asset manager. And so the asset manager creates now the different funds that appeases to your own individual requirements as an investor, right? So the same thing as the other route is you don't have to carry out any stock analysis before trading, right? And the asset manager does the portfolio development for the investor and simply explains the mix to the investor. All right. So it's more of a graduating scale. When you're starting out, for anyone over here who's starting out, the first route might be taking the financial intermediary route. Let them choose the specific basket of stocks for you that fits into your portfolio and investment objectives. Okay, then the next thing is you can consider the mutual fund route, right? Or route, whatever the pronunciation. So what it is you do over here is you now consider this equity fund that has these specific characteristics that fits your goal as an investor, and you check out, let's say, for example, your 300K or your 50,000 shillings or your 10,000 shillings or even your 1,000 shillings, okay? And you now invest in that mutual fund that is already balanced by the asset manager, and the asset manager now does all the buying, selling, and balancing for you, okay? And when you're confident enough and you understand the markets enough for you to be able to invest by your own self, you can take the individual trading route, Okay, so this is where now you get to do it individually. So just let's say, for example, I've made some simple, let's say 2,000 or 3,000 shillings. I did a side gig today, all right? And I have some cash and I've pretty much met all my expenses. So let me invest this cash. Okay, so this is mostly suited for investors who understand the valuation of equity securities through fundamental and technical analysis. I will explain this, don't worry. Okay, and all the investor has to do is set aside the required amount for the fund, which can be bought at their own preference. So let's say if it was my birthday this December and someone sent me 4,000 shillings, and I'm like, oh, thank you for that birthday gift. Let me do something with it. If I understand all these things and I've done my own analysis, I can be able to do this by myself without any intermediary. All I just have to take is use a broker's online portal, which is a must for anyone who wants to invest in this market. Okay, and the advantage of this is that you have control over your portfolio and you're able to identify and exploit discrepancies in the market, because the asset manager cannot take certain risks because it's different people. Okay, they are quite limited, but for you as an individual investor, you can do pretty much anything you want. Okay, so to explain the fundamental and technical analysis, simply put, fundamental analysis, you look at the core details of this company, all right? And this is found in the financial statement. So a fundamental analysis pretty much look at things like, so how has this company been performing? Has it been profitable for the past 3 years? Okay, has this company's industry been growing? If it's Safaricom's telecommunication industry, has the industry itself been growing? Let's say, for example, 10 years ago, we were at 3G, all right? 2011, we were at 3G. Now we are almost at 5G, all right? So it shows that the industry has been growing. How have they been paying dividends for the past 3 years? Has it been increasing, all right? Have they been making consistent cash flow? All right. So let's say, for example, has M-Pesa been bringing in more and more money as the years have been going by? All right. So that's pretty much your fundamental analysis. But this one we cover it more in our Fitnances Academy as it's quite detailed. Okay. And the next thing is now your technical analysis. And so technical analysis pretty much means now what traders do. Okay. So let's say, for example, if you see a chart like, let me just switch my screen over here, just to show you guys. Let's say if I go to a site like Trading. All right, so if I get to see, excuse me. So if I get to see all these red and green shenanigans, what does it mean? Okay, so for a technical analysis, let's say, for example, if I'm an investor, so this is an Apple stock, all right? So if I'm a technical analysis kind of investor, I will look at different parameters according to this chart and be able to identify whether to buy this security or not buy this security, all right? So for example, if we look at its valuation, Apple's valuation year to date, you'll see that at this time last year, it was trading at around 132. So if someone was able to study this chart well, even without looking at the fundamentals, they were able, let's say, at this point to actually know that this company is increasing in valuation, you see, and they actually did. If you follow these things, you'll realize that around this time is when Apple launches new products. So they launched the iPhone 13, they launched the iPad Pro, they launched the MacBook M1. So guys were, oh, wow, so this is good. Let's buy this company, okay? So the people who just look at this chart and see if that's a good investment opportunity or not. And this is mostly used by traders, okay? So day traders or Forex guys, guys who trade in the Forex market, in the gold market. So these different things that you hear about. So this is what it is that they look at. They look at this chart. So these are called candlesticks. Let me just zoom in a little bit. And there's a certain way that they are explained. So when you see this candle, let's say shaped like this, you might know that it's about to go up or it's about to go down. So this is pretty much a fundamental analysis. Are we together, guys, or I've already lost you? Are we together? Yo, our time is much gone. I am so sorry. I am really, really sorry. Are we together? Or guys dropped off? Okay.
We are here. Ted. We are here. Ted.
All right. Thank you so much. Okay. So, so the next thing over here is one of my most favorite quotes again by Warren Buffett that says, you have to understand accounting and you have to understand the nuances of accounting. It's the language of business and it's an imperfect language, but unless you're willing to put in the effort to learn accounting, how to read and interpret financial statements, you really should not select stocks yourself. Why? Because it just involves a lot of financial analysis that is required for you as the investor. Okay, so that's pretty much it. So I just want us to do a live demonstration as the final part. If there's, let me check if there's anything else, the dividend computation and where to start. And I think we'll just have to do fixed income securities some other time. All right, so before we do the live demonstration, I want us to look at how it is you calculate dividends, and I'll keep it as simple as possible. All right. So within every company's legal documents, there's a part where a public company will have a dividend policy. So a dividend policy basically means that out of this profit, a certain percentage will be given out as dividends. Is that clear? Let me repeat again. Out of profits we've made as a company, this certain specified percentage will be given as dividends, and the remaining percentage will be considered retained earnings or retained profits. I hope that's clear. Okay, so what happens? So let's say, for example, Safaricom's dividend policy is at 80%. So, so if Safaricom made 100 million shillings, it means that 80% will be given, 80% of that, which is 80 million, will be paid out as dividends. Are we together? Okay, so for example, 80 million is the full amount that will be given to 40 million shares. I hope that's clear. All right, so this is the ordinary share capital that Safaricom has in the market, for example. So for you to get your dividend per share, it means that we'll have to first of all find how much dividends for one share. And so that will basically be 80, all right? 80 divided by 40, and that is 2 shillings of dividends per share. Is that clear? So for example, if your share ownership of Safaricom is 100 shares, then you'll make how much in dividends? 200 shillings. Okay. If your share computation of Safaricom, let's say it's 1 million shillings. All right. So if it's valued at 2 shillings, it basically means that you will make that year 2 million in dividends. Are we clear? So the good thing with dividends is the more shares you have, the more amount you'll make out of dividends. All right. And if you are to go back to capital gains, if you bought it at 5 shillings and you sell it at 40, you know, and you have 100 shares for that matter. So it means you bought it at 500 and you've sold it at 4,000. So it means you've made 3,500 shillings, right? If it's 1 million, you bought it at 5 million, you sold it at 40 million, it means you've made 35 million shillings as your capital gains. I hope that's clear, guys. Okay. So the other thing over here is your earnings per share. This is an also important one to burn, but the earnings per share, it's basically the 100 million profit divided by the current shares that are in the market, which is the 40 million shares. So it means that the earnings per share is around, so this one will be around 100 divided by 40, so that will come to around 2.5. So this is basically just shows for each share, this is the amount of profit that was generated for each share. But remember now, when you're checking the dividends, you'll have to check the dividend policy first, know how much of the profits are going to be distributed as profits, okay? And if as dividends, sorry, and if it's 80% that's going to be distributed as dividends, then you'll use that amount. So if it's 80% of 100 million shillings, only means that 80 million shillings will be distributed as dividends, and that will eventually make 2 shillings per share. All right. So that is it for this. On to the final bit, which this one is pretty much straightforward. So what you need to have in place, you know, a well-developed financial plan, an investment policy statement, investment goals and constraints. All right. So these are things that we've pretty much talked about, you know, asset allocation criteria and the security selection list. Okay. And then you'll have to open a CDS account with your broker. Remember the financial intermediary, as you need to constantly work with them. And you now need to choose your preferred investment route. Will you want the broker to do that for you? Will you invest in a mutual fund, in an equity or stock mutual fund, or will you buy it by yourself? All right. So for the final thing tonight, guys, I just want to show you a live demonstration of how you buy and sell on the NSE platform as an individual investor. Are we together? Are we lost? Are we bored? Are we tired? Are we confused? Are we there? Hello?
Yes, sir.
All right, awesome, thank you. So for the final thing tonight, so personally, I use AIB Axis, and also there's something that I just want to briefly show you guys. Especially when you're choosing a broker, all right? Because there are different things that you'll have to look at. And let me just get that list for you. Where is that list? Where is that list? Why is it not responding? All right, so you can see here is a list of trading participants. So these are pretty much a list of brokers that exist in the market. All right, so there's Dan Blair, there's Francis, there's Ngenya, there's Old Mutual, Suntra, Kingdom Securities, AIB, Genghis, you know, Absa Securities, Equity Investments, and there's something I'm looking for, but I can't see it right now. I don't know where it's hidden. Just give me a moment to find out where it is. Where is it? Oh yeah, here it is. So when you want to trade as an individual investor, you'll have to look for banks that can be found in these categories. All right. So for example, this is on the NSE website. So when you come over here, you look at the online trading, and you'll see that these 15 banks will have a platform like this. I hope I'm clear on that, okay? So these 15 banks, Dan Blair, Suntra, Kingdom Securities, AIB Axis, FIDA Investment Bank, Genghis, NCBA, Standard Investment Bank will have an online platform where you can be able to buy and sell by yourself, okay? So The next thing is when you check on the mobile, if you prefer to trade through your phone and not through, let's say, like a computer or something of that sort, you can check on this. You can check on this 8 different investment banks. So which should actually help you narrow down. For example, if you're looking at this list on which are the most preferred banks, okay? So let's say, for example, Dan Blair had an online platform. All these banks actually had an online platform. So if you still want to consider mobile trading, which is an app, so you can consider these different banks that are listed on this list, okay? So it's found on the NSE website. I just wanted to make that clear to you guys so that you're able to know how to navigate through it, okay? So moving back to our portal, so you'll just get to log in. It's fairly simple. Yeah, and welcome. So this is the NSE platform, so where you can actually buy and sell. All right, so over here you have listed companies according to their ticker symbol. So the ticker symbol is pretty much like a short form. So like CTUM refers to Centum Investments. Crown Paints Kenya, okay. Gold, New Gold, this is the gold ETF. KPLC, okay. KEGN, it's Kengen, all right. So SASN, Sassini, Escom, Safaricom, and so on and so forth. All right. So navigating through this platform, the next thing is, so let's say, for example, you come over here. So this is my available funds that we have for investing tonight. So I have around 4,000 shillings in my account. Okay. So this is where you're able to check. The next thing is you're able to check your valuation. My simple valuation up until this point is around 13,000. And yeah, so you'll see that what I managed to do this year. So my NCBA portfolio dipped, but I made a significant progress in, let's say, in equity. Bought it at 37 and it's currently at 50. So if I sell, I'll make this profit. All right. So that's the portfolio valuation bit. Excuse me. Okay. And so if I want to withdraw, let's say, for example, if I sell and there's funds in my account, if I want to withdraw, I will definitely come to this portal. And if it's 4,000 that I want to withdraw, I can come over here and it can be either via check or just any payment option that I agree upon with my investment broker. Okay. And over here is just where you can monitor the orders that you've made, because this is a cart. Yeah. And yeah, so this is just pretty much for information and everything. Okay. And over here at the bottom, you have your statement. So with your statement, it's basically where you're able to monitor your statement, your stock statement. Okay. Your order status basically means if I place an order tonight and I have it to, let's say, to be executed by tomorrow, Friday, I'll be checking on this list. Okay. And then off-market orders, let's say it's orders that we are making at this moment, our current position. These are contracts which I won't be able to explain right now because of time. Intraday trades basically means when you're buying and selling within a day. You know, let's say if it's tomorrow, in between tomorrow, Thursday, from 9 to 3 p.m. If I've made intraday trades, that's where they're going to be showed. And my order history, what I've bought before, and my risk monitoring report. Okay, so just to make things simple. So let's say, for example, tonight I've done my analysis, and you can see that most guys actually want to buy, all right, but no one really is selling. Okay, and if someone is selling, they're selling at 42, and most guys want to buy at 30. Around 38. Okay, so you'll see, for example, someone who wants to buy, who's demanding 442,000, all right, worth of Safaricom at 38.05. It basically means that they want to invest 16 million shillings into this company. Okay, so for someone who wants to do 83,000 shillings or 83,000 shares, times 38, that's around 3 million shillings. 30 million, you get the gist. 2,100, you get the gist. 1,000, you get the gist. All right. So what you might realize is most of the times you might find that this is an institutional investor. It's a company, let's say, that wants to invest in the securities, or alternatively, it might be an individual as well, who wants to invest 16 million shillings into Safaricom securities for this demand price, right? And also something else that I've not mentioned is the buying and selling, as any other product, is affected by forces of demand and supply. Okay, so that's also something that you'll have to constantly check on. Okay, so if I want to buy, what it is I'll come and do is I'll come over here first of all and indicate my quantity. I'm still a small scale investor right now, so I'll take 100 shares, which is the minimum amount. Okay, and for someone who asked what's the minimum that I need to invest in shares, if you take the financial intermediary route, they have the capability of working with what it is you have, right? But a good valuation for the financial intermediary route, if you want different securities, a value like 10,000 shillings would make sense. But if you just want 2 or 3 shares, just to put some money into shares, but you really don't want to do the valuation, they will be able to tell you what's the minimum amount that you need. Okay, if it's the mutual fund route, they will tell you that you can buy a minimum, let's say, of 100 units. So if it's 9 shillings per unit, so it means that's 900. If it's 152 shillings per unit, it means that's going to be around 15,000 shillings. So it depends. Okay. So when it comes also now to individual purchasing, what it is that you're going to look at is what is the security that you want to buy and what's the price for the minimum amount. Okay, so let's say, for example, I want to, because most guys want to buy, but not most guys want to sell. So let's say, for example, I get to bid at 38, right? So this is called the bidding process. So at 38, and I'll have to set, why is it bringing my Visa card? This is weird. All right, so, and let's say I want this order to execute by Friday, all right, by Friday 31st. So you can see that my order value is, excuse me, is 3,800 shillings, okay? And so this valid up to basically means it's when my order is available in the market, okay? So if someone by this date will be willing to sell at 38 shillings, they will be able to, for example, they will be able to purchase these securities. They will be able to sell these securities to me. All right. So that's how the order process works. It has names to it, but we can't cover it right now. It will make things complicated. Right? So delivery or intraday. So this basically means if I choose delivery, it means that even if this security dips, excuse me, to 38 all the way from let's say 42, all right? If this security right now, it's currently, let's say 39.55. So if this security dips even to 36, but I've selected delivery, it means that it will not exercise or it will not trade until this date which I've selected. All right. If I choose intraday, it means that even if tomorrow morning someone decides to sell at this certain price, it means that the order will execute. It's okay. It's okay, Vaughn. Thank you so much. Thank you so much. Yeah, I'll definitely share the notes and the link to the session. All right, guys. So that's pretty much how you go about it. So let's say, for example, my bid is at 38 and I'm buying a lot size of 100 and I've made any intraday, all right? Any intraday price variation, I'll get to buy this, okay? So I'll just come and do a buy, all right? And now you see the company, the investment bank will now include its brokerage fees. So 49 shillings, Okay, so you can actually do that math to identify how much that is. 49.4 divided by 3,800, so that's around 0.0013 times 100, so that's 1.3% as brokerage fees. Okay, and then these are the transactional charges. So our net consideration is 3,800 plus this extras, which comes to 38.64. And I will submit my off-market buy order. And yeah, all I just have to do is check my inbox and purchase my securities. Okay, so I'm really sorry, guys, it took much of your time. I know some of us got to drop off, but I'll definitely share this recording with you guys, and I think I'll text you guys to see if we'll do another recorded session, or I just get to record the session as well and share the link with you guys, which I prefer the latter. All right, so that you're free to do any other thing as you had initially planned yourselves. But all in all, I am thankful so much for having you guys over here, those who've stuck from yesterday all the way to today, those who joined us today, those who stayed here for all this time, almost 3 hours, man. I'm so sorry, but I'm really grateful that we managed to cover this, and I really hope from the bottom of my heart that you managed to learn something out of this. Okay, so allow me to stop sharing my screen, and yeah, thank you so much for all you guys who managed to remain up until this time, and I'll definitely share these notes with you guys. So have an amazing evening. Thank you so much. Yeah, and we'll see you next year in any other future event that we are going to have. Okay, cheers. Thank you, guys.